We're talking markets today with Jon Driedger of Leftfield Commodity Research. Jon, as we think, we've talked about the three things to key on. Like I said, it's not a totally inclusive list, but those are the three things, the top things that you've brought to us today to discuss. I guess when you think about the direction of the market in 2023, we heard your colleague Chuck Penner on this show, Real Ag Radio, going back to probably October, November, talking about the potential that these current commodity prices are a bit of maybe a new normal, so to speak. Based on what you know today here, early days of 2023 in January, what do you think about where we are from a pricing perspective? Is it a higher probability that we go higher from here or we go lower from here?
I think in light of maybe where we're sitting currently, and again, as we just chatted about just before, we're already at really elevated levels. I think when we think about a new normal, I think in the context, and often you think about from a multi-year perspective, I think it's just, in our view, it'd be an element of just trading at a higher range of values than we maybe had in the past. You sort of, and we've seen those things historically before, where prices trade along and then they sort of make a step up to another level, and then they make a step up to another level. And I do believe that that's something that has taken place probably for most crops. So what does that mean going forward? Are we going to trade higher from where we're at today or lower? I would say that probably for some of these crops, you could justifiably say that we end up trading in a wide range. Again, barring, either perfect weather and you put some extra pressure on it, or all the bullish factors stack up. Those things, of course, are possible. But we think about a new normal, it'd be one of those where maybe just that trading range that we've seen is at an elevated level compared to what we've seen in the past. So, I think going forward, are we going to be higher or lower than where we're sitting at exactly today? For all the reasons we talked about, that's hard to tell. But even if some of the negative things line up, I don't know that we necessarily trade all the way down to, what had been previous lows, for example, 5-6 years ago, that sort of thing. I think that floor probably gets established at a higher level than what it had been before. Often that's where the market had seen resistance previously. Again, you can, parse that out by crop. Are we going to actually make new highs compared to what we've seen previously? I don't know about that. We've saw some incredibly high levels not that long ago. You might need a lot of things to stack up in the right way to even, sniff at those. But I think trading just at a range that's more elevated than what we've seen in the past, I think that's pretty reasonable for a lot of these crops for a host of different reasons. I think it would almost have to take everything sort of stacking up on the bearish side to even, to kind of even, sort of test what had been previously normal levels. So that's how I would maybe view it, rather than saying, are we going to be higher, 3 months from now or lower 3 months from now? Again, all the reasons we talked about, that's hard to pin down. But I think trading in an elevated range is a reasonable expectation.
Basically from, I don't have the chart in front of me, but say September through the end of December, we really saw that volatility leave the market. If you look at the charts on most commodities prior to fall versus fall and beyond to the end of the year, there's a difference in terms of how much the market moved. Is Mother Nature really that card to be played in terms of bringing that volatility, that opportunity back to the market to take some risk off the table from a marketing perspective?
I mean, obviously it can be, right. And as often is the case with weather markets, you kind of sell the rallies and buy the dips, in a lot of these cases. Often it, kind of overshoots in both directions when weather is the driving factor. But I think, to speak to your point, Jon, I think in terms of some of that volatility, and I think one of the things to remember as well, and we talk about how prices, historically are still very high. We kind of settled into trading ranges at historically high levels. And yet within those ranges are pretty wide. And so you think about something like canola was about $100 per ton trading range. And so you kind of feel like, you're sort of drifting in a range. Well, it wasn't that many years ago where you wouldn't trade in $100 range over the course of like a 3-year span. Now that's sort of where we sort of settle into the mundane trading range. That's $110 per ton trading range. As a percentage of value, it's a little less dramatic because we're trading around $850 rather than, $500. But I think it sort of speaks a little bit to that point where maybe, we trade at this elevated level, trading in a range. But then again, you have, for example, if the weather stacks up on the bullish side, you might trade to the top of that range, maybe even push through it potentially. And that maybe is an opportunity for growers to lock in some pricing. It's totally cliche, and yet there's a lot of truth to it. High prices are the cue for high prices and so forth. I think it's one of those to be cautious about being too complacent. And when you talk about a new normal, if you will, being too complacent that prices are high and they're inevitably going to trade higher. Even at high prices, you can see some pretty sharp pullbacks. So I think those are all things that farmers need to be, thinking about when they plan their marketing, doing their risk management plans, taking advantage of rallies. How does that make sense in your business? That sort of thing. I'd caution against complacency is maybe how I would phrase it.
100%. So what I was just going to say is what worries me when we don't have the volatility is that complacency. And when the market starts to drift in either direction, we don't see those headlines from publishers like us, where it's like, markets limit down for 3 days or limit up for 4 days, that kind of thing that grabs people attention. I better pay attention to what's going on here. When it drifts, it gets a little bit less attention. Then before you know it, you look at the market like, man, it's down 75 cents. What happened here? Or it's up $1 and I haven't taken advantage of this, right? So complacency, when we don't have that volatility, is really dangerous if you're not following the market on a day-to-day, week-to-week basis.
Oh, I totally agree with that, Sean. And in many ways, it is one of those, again, as you trade in a bit of a range, and farmers know how tight a lot of these balance sheets are, like we talked about, and all the reasons why, you might see prices, trade higher and, maybe even project to new highs. We don't think that's going to happen, but you can't take it off the table for all the reasons we talked about earlier on. If all that stacks up on the bullish side, there's tremendous upside potential because balance sheets are tight, but also, prices are historically high, and it wouldn't take that much to just kind of put a bit of a malaise in the market. You drift a little lower and look back and say, geez, markets are off quite a bit, and maybe we missed an opportunity to do something, lock in some minimum prices, use some put options, lock in just some cash prices, whatever the case is, right? Using those tools that are available, because complacency is, it's easy to get lulled into that when we're not making headlines, kind of like you mentioned. And yet it also really is a trap that's easy to fall into. If we're not, kind of being cognizant of the fact that, values are pretty attractive, how do we think about that, navigate that, and do something instead of just assuming that balance sheets are tight, it's a new normal, prices will be fine forever.
Yeah.
That's a little too presumptuous, maybe.
Well, I often hear people say, I'm not even going to look at the market. I'm just going to walk away. I'll come back in 3 months and I'll see. Like, that's not being disciplined.
No, exactly. Right. And it's one of those things that we got the last.
Right? You put your crop in the ground. You never say, I'll come back at harvest and see how we made out. That's just not how that works. Like,
totally right. And it's one thing to have that attitude if you got the last 25% in the bin and you're in good position and you're like, I'm not worried about this pressure the market's under because I got a long-term plan or that sort of thing. But you're right. It's a bit of a balance between not having a knee-jerk reaction to every headline or every 20-cent move in the market or overreacting, which can happen too. And we see whether it's the funds kind of causing overshoots or all those sorts of things that could happen. Obviously, you don't want to be overreacting, but being attentive, being disciplined, not being complacent, it's easy, like you say, to kind of just, kind of park it for a few months because maybe you don't like what's going on. And that's obviously not the right approach either.
Well, and with our audience, there's people that are in the cash cropping business that are like, I really hope the market's higher in 2023. Livestock producers, on the other hand, are like, are you kidding me? I could use some cost relief when it comes to feed costs. So we have audience members on both sides of this equation for sure. Hey, John, this has been great. Happy New Year to you. Hey, if somebody wants more information from Leftfield Commodity Research, where do they find it?
Yeah, our website is leftfieldcr.com. That's the easiest place to find us. We're also on Twitter as Chuck and myself. And so, reach out to us and happy to chat about what we do and find out also about your farms and your businesses as well.
Great stuff. Hey, John, thanks a lot for joining us.
Hey, thanks, Sean.